Markets just witnessed one of the most dramatic reversals in precious metals history. Gold plunged to $3,180 per ounce in Asian trading before staging an explosive recovery back to $3,420 as I'm recording this. That's a $240 bounce, a 7.5% move from the absolute low. Silver followed suit, dropping to 88 before clawing back to 94.50, representing a 7.4% recovery from its intraday bottom. The question everyone's asking right now is whether this marks the end of the correction, or if we're simply seeing a dead cat bounce before more carnage unfolds. In my last analysis, I outlined a specific framework for understanding this correction. I emphasized watching the dollar index as our primary leading indicator. The logic was straightforward. When the dollar experiences sharp moves, particularly to the upside, it creates immediate pressure on dollar-denominated commodities like gold and silver. My specific level to watch was 108.50 on the dollar index. I stated clearly that if we broke above and held 108.50, expect accelerated selling in metals. The dollar index pushed to 109.20 before pulling back. I warned that a sustained break above 108.50 would confirm additional weakness ahead. Go back and watch that video. This wasn't speculation. It was the foundation of why I anticipated further downside pressure. And that's exactly what materialized. The dollar strength triggered liquidation across precious metals. Gold hit 3,180. Silver touched 88. Now we're seeing this bounce, and the critical question is whether New York trading will validate this recovery or reject it completely. I've been reading through hundreds of comments on the previous video. The engagement level is incredible and shows me you're actively using this information to navigate these volatile conditions. What's interesting is the clear divide in sentiment. Some of you are positioned defensively, expecting another wave lower. Others remain committed to the long-term thesis regardless of short-term price action. That split isn't a problem. It reflects a community of independent thinkers executing their own strategies based on their own analysis and risk tolerance. That's precisely what we cultivate here. Critical thinking over crowd mentality. We don't package fear or greed into digestible content designed to manipulate emotions. This isn't entertainment with predetermined outcomes. These are real markets with real consequences. Before we go further, an essential reminder for anyone new to this channel. I do not sell courses, signals, premium memberships, or any paid services whatsoever. Anyone contacting you claiming to represent me or offering paid services is a scammer. Block them immediately and report them. My only presence is on YouTube and X under this handle. Those are the only legitimate sources for my analysis. I have no association with any other accounts, platforms, or services. Protect yourself. I will never ask you for money or personal information. Now let me walk you through the current market data as of this recording in pre-market hours. Shanghai gold spot is trading at 3,890 per ounce. Shanghai futures at 3,910. Western spot at 3,420. Western futures also at 3,420. That gives us a premium of $470, which translates to a 13.7% premium. This is down significantly from the 24% premium we saw at the peak of the weekend dislocation, but it's still a substantial 13 to 14% premium in pre-market conditions. The volatility remains extreme, and we're waiting to see how New York participants respond when the market opens. Here's the broader context of what transpired overnight and into this morning. Approximately $8 trillion in wealth was erased across global markets in just 4 trading days. Gold declined 18% from its recent peak, eliminating roughly $6.2 trillion in market capitalization. That's more than 3 times the entire market cap of the cryptocurrency sector. Silver crashed 35% from its highs, wiping out approximately $2.1 trillion in value, equivalent to nearly the entire U.S. corporate bond market. We're watching safe haven assets behave like speculative technology stocks. This continues to be the market's reaction to policy uncertainty and liquidity concerns. But here's what makes this different from a typical correction or crash scenario. Central banks haven't reversed their gold accumulation strategies. Countries like China, India, and Turkey continue their buying programs. Tether hasn't liquidated its gold reserves. The U.S. fiscal situation hasn't improved. In fact, we're seeing renewed concerns about debt ceiling negotiations and government funding. So why is gold experiencing this level of selling pressure? There appears to be a significant disconnect between the various markets where gold trades. The second explanation is forced liquidation. Someone or multiple entities need liquidity immediately and are selling whatever they can sell, which means extensive paper market activity because, fundamentally, nothing changed in the macroeconomic landscape since last Thursday, except possibly stress emerging within the financial system. The way gold is selling off, while equity futures show mixed signals, bond yields fluctuating, and the dollar exhibiting strength, this isn't ordinary price discovery, It's stress-induced selling. When gold gets liquidated this aggressively, it typically indicates something is approaching a breaking point in the system. This has all the characteristics of a liquidity event. During genuine margin call situations, institutions don't sell what they want to sell, they sell what they must sell to meet requirements. Gold and silver are highly liquid markets with substantial open interest, making them prime targets when margin clerks demand collateral immediately. Now here's the evidence that demonstrates this is paper market dynamics rather than physical market fundamentals. Dealers in Germany and Switzerland are reporting increased buying activity, not selling. In Dubai and India, premiums remain elevated and physical availability is constrained. In Singapore, one of Asia's primary gold trading hubs, dealers confirm steady demand even as prices declined sharply. In China, the premiums tell the real story. Silver availability particularly tight across Asian markets. In Australia, major dealers reduced their online inventory offerings due to overwhelming demand. Physical buyers continue purchasing gold even as prices collapsed, demonstrating the resilience of underlying demand for tangible assets. Looking at the metrics here, approximately 68% of viewers aren't subscribed to the channel. If this real-time unfiltered analysis provides value and helps you navigate these conditions, consider subscribing. If it's helping you make better decisions, leave a comment. I'm here for those seeking substance and clarity without the manufactured drama. One of Asia's largest precious metals dealers confirms that physical gold demand increased substantially during last week's price decline. They're observing a widening gap between paper pricing mechanisms and physical market reality, and they anticipate this divergence will intensify. Meanwhile, premium gold products on major Chinese retail platforms are trading at significant premiums to spot prices. Standard 1-ounce gold coins on Alibaba's Tmall platform are listed at $3,685 today. Comex is at $3,420. That's a $265 premium, or roughly 7.7%. Let that register. Physical retail gold in China trading nearly 8% above paper gold prices in New York. And here's what's critical. The gold forward curve shows signs of tightness in near-term contracts. You cannot resolve a physical shortage through paper market manipulation. The manipulation is disconnected from actual supply and demand dynamics. It's designed to manage perception and potentially prevent instability in Western financial markets due to decisions made by policymakers and central bankers. The scale of what's occurring behind closed doors must be substantial. The tightness in physical markets indicates genuine scarcity, while paper markets are being used to suppress price discovery. All these short positions will eventually need to be settled either through cash settlement or physical delivery. They're engaged in an increasingly precarious game. We're witnessing a precious metals repricing process where Comex and LBMA are experiencing sustained physical drainage, particularly in silver, but increasingly in gold as well. The entities shorting paper contracts are primarily focused on maintaining suppressed paper prices while attempting to cover positions and minimize losses. When this process reaches its conclusion, the full revaluation will manifest, and gold specifically could trade substantially higher, potentially reaching levels that reflect true physical scarcity rather than paper market dynamics. What's revealing is how the positioning on gold futures at Comex continues to tell a contradictory narrative. Yes, they succeeded in driving prices lower throughout last week, but the actual volume patterns remain relatively balanced outside of concentrated large block trades. This indicates price is being influenced through a combination of algorithmic trading, concentrated selling during low liquidity hours, and coordinated activity during U.S. sessions because the downward price pressure triggered derivative unwinding on major ETFs like GLD and IAU, creating cascading sell orders through stop-loss levels. Importantly, this has minimal connection to the physical market where underlying fundamentals remain intact, and physical tightness continues to intensify. Shanghai Gold Exchange withdrawals remain steady. The Shanghai premium structure is still functioning, though it needs to stabilize here. Shanghai Gold futures hit daily limit down on one session, causing contracts to lock at the lower bound with heavy one-sided selling and effectively no two-way market for the remaining session. This confirms the Chinese market is experiencing pressure as well. However, physical vaults show stability. The premium structure is holding. Physical markets aren't breaking. Only paper markets are experiencing stress. Now let's discuss what New York's opening could bring. Two distinct scenarios, starting with the bearish case. If New York opens and selling pressure resumes, we could see gold retest 3,180 or potentially break lower toward 3,100. The $240 bounce from 3,180 to 3,420 might simply be a technical relief rally before another leg down. Comex implemented margin requirement increases yesterday. If market participants cannot post the additional capital, forced liquidation continues. The dollar index at 109.20 already confirmed the strength I predicted as a bearish catalyst. If it pushes higher, toward 110, that intensifies pressure on all dollar-denominated assets. The U.S. Treasury faces approximately $7.8 trillion in debt maturities over the next 12 months, the highest level on record. This represents nearly double the amount seen before the pandemic crisis. This accounts for roughly 31% of all outstanding federal debt, among the highest percentages historically. Most of this debt must be refinanced at significantly higher interest rates than the maturing debt. The U.S. fiscal situation is reaching a critical juncture. This creates systemic pressure that could trigger additional selling across all asset classes. We're potentially watching multiple bubbles deflate simultaneously. The S&P 500 trades at valuation multiples that exceed historical peaks, including 1929, 2000, and 2021. A reversion to mean valuations would be severe but arguably overdue. Historical precedent shows that during deflationary crashes like 2008 or March 2020, precious metals initially decline alongside equities. When metals stabilize while equities continue falling, that typically marks the bottom for metals. Until that divergence occurs, the deleveraging process will be painful. That's the bearish scenario for the New York session. But here's the bullish perspective. The bounce from 3,180 to 3,420 is holding through pre-market. If New York opens and this recovery continues, we could see gold reclaim 3,500 and potentially test 3,600 by session close. Sharp declines are engineered to create capitulation. That's how markets eliminate weak hands and impatient capital. Gold and silver just experienced a correction, but the macroeconomic backdrop hasn't changed. Sovereign debt, fiscal deficits, geopolitical instability, monetary policy uncertainty all remain in place. Corrections are normal and necessary for healthy bull markets. Volatility doesn't equal trend reversal. Gold is nowhere near bubble territory, significantly undervalued relative to money supply expansion. Gold to silver ratio currently sits at 36 to 1. Historical norms suggest 15 to 1. Comex vault ratios show silver to gold at roughly 12 to 1 by weight. Mining ratios approximately 8 to 1. LBMA vault ratios closer to 4 to 1, above ground. Refined supply roughly 1 to 1. Fundamentals will eventually dominate the pricing mechanism. When that occurs, silver should appreciate dramatically to realign with these ratios. People need to understand that in Western gold and silver markets, paper claims on metal far exceed actual physical metal. This sell-off represents paper dumping designed to discourage retail participation in metals. As equity markets face challenges, look how unstable gold appears. But informed physical buyers understand the difference. Singapore seeing increased activity, Australia experiencing strong demand, China and Hong Kong facing supply constraints with elevated premiums, Chinese retail platforms showing 8% premiums. This is physical demand overwhelming paper supply in slow motion. Major institutional sentiment indicators are registering extreme bearish readings. From a contrarian perspective, excessive pessimism often marks bottoms rather than tops. For those who perceived value in gold at 3,800 last week, the current price of 3,420 potentially represents improved risk-reward dynamics. That's the opportunity being presented through this volatility. Gold is down approximately 12% from Friday's close, but from the 3,180 low, we're already up 7.5% to 3,420. So what am I monitoring when New York opens? First, does the bounce from 3,180 to 3,420 hold, or does it fail and we retest the lows? Second, does the dollar index stabilize at 108 to 109, or does it break higher toward 110? This will show us if the liquidation pressure is complete or if more is coming. Third, do equity markets stabilize or gap down aggressively and drag metals lower with them? Fourth, does the Shanghai premium hold at 13%, or does it compress further? If it compresses toward 5% or lower, that signals physical markets are weakening. If it holds or expands back toward 15 to 20%, that signals physical strength and paper market control diminishing. Fifth, do we receive any developments regarding banking sector stress, government funding resolution, or geopolitical events in the Middle East? Any of these could move markets violently in either direction. Where does this leave us? First, physical and paper markets are completely disconnected. Germany and Switzerland seeing buying activity as prices crash. Dubai and India experiencing sustained demand. Singapore and Australia reporting strong physical flows. China, retail platforms at 8% premiums. Physical tightness in near-term forward contracts. Shanghai vaults stable. This is not a fundamental breakdown. This is paper manipulation and forced liquidation while physical demand increases. The divergence between paper and physical is expanding, not contracting. At some point, one of these markets breaks. History strongly suggests it's the paper market that breaks, not the physical market. Second, the New York session will determine if 3,180 was the bottom or if additional selling is ahead. The $240 bounce to 3,420 is encouraging. Gold up 7.5% from lows, silver up 7.4%. But we need New York to confirm. If the bounce holds and builds momentum, the worst might be over. If it fails and we retest 3,180 or break lower, more pain likely before the true bottom. Watch the opening action carefully. The unresolved question is this. Gold hitting 3,180 with a 7.5% bounce to 3,420. But does New York validate this as the bottom, or is this merely a technical relief rally before more downside? Physical markets are signaling strength. Dealer activity, premiums, forward curve tightness, supply constraints. Paper markets are signaling stress, forced liquidation, margin calls, concentrated selling, algorithmic pressure. Which dynamic prevails when New York opens? Conduct your own research and understand the risks, because this volatility is exceptional. Leveraged trading in these conditions carries extraordinary danger. Think independently. Use your own judgment. Don't follow anyone blindly. This is real risk with real consequences. While many are observing a significant divergence where paper market selling contrasts sharply with physical market tightness, it's critical to interpret this carefully. The recent low of 3,180 may represent an entry point for some, but it could also be a temporary pause before further decline. New York will provide the answer. Stay alert, watch the data, invest with logic, not emotion.